studying your last two. I swim with tea when they turned in. The staring down to mute and can lend a pole that some kid died.
Have you ever wondered why small businesses pay a lower corporate tax rate than individuals? At first glance, it might seem like the government is simply giving corporations a tax break. But the real reason is much more strategic. The Small Business Deduction was created to help businesses grow. Imagine a business earns $100,000 in profit. If that income is earned through a qualifying corporation, only about 12% may be paid in corporate tax. That leaves approximately $88,000 available inside the company. Instead of sending all that money to the owner, the business can reinvest those funds to expand its operations. That extra cash can be used to hire employees, purchase equipment, invest in marketing, or even open new locations. The government wants successful small businesses to have access to capital so they can grow faster, create jobs, and contribute to the economy. This is why qualifying active business income receives a lower tax rate. But there is one important idea to remember. The Small Business Deduction was never intended to create permanent tax savings. Its purpose was to provide businesses with more cash today so they could reinvest, expand, and build stronger operations for the future. And that key idea will help us understand why the government later introduced the passive income grind rules. In the next section, we'll see the problem the government believed this tax advantage was creating over the long term. Now that we understand why the Small Business Deduction was created, let's look at the problem the government eventually identified. Imagine two people who both earn exactly $100,000 of business income. The first person earns that income personally. The second person earns it through a corporation that qualifies for the Small Business Deduction. At first, everything seems fair. Both individuals generated the same economic income. But after taxes, the results look very different. The individual earning income personally pays tax at a higher personal rate and is left with approximately $65,000 available to invest. The corporation, however, pays tax at the lower small business rate and is left with approximately $88,000 available to invest inside the company. That means the corporation has an additional $23,000 of investment capital every single year. And this is where the government's concern begins. 1 year of extra investment capital may not seem significant. But what happens when this advantage continues year after year? After 10 years, assuming the same income is earned annually and ignoring investment returns, the corporation has accumulated approximately $880,000 of capital. The individual has accumulated about $650,000. That's a difference of $230,000 before considering any growth, interest, dividends, or capital gains. Once investment returns are added, the gap becomes even larger. From the government's perspective, two taxpayers earned the same income, yet one was able to accumulate substantially more wealth simply because the income was earned through a corporation. This became known as a tax deferral advantage. The government wasn't necessarily concerned about the first year. The concern was what could happen over decades as corporations continued to retain profits, invest those profits, and build increasingly large pools of wealth. Understanding this concern is essential because it explains why the government eventually introduced rules to limit some of these long-term advantages. And that's exactly what we'll explore in the next slide. At this point, the government had identified a problem. Successful corporations were earning active business income, paying tax at the lower small business rate, retaining those profits inside the company, and then investing the excess cash into stocks, bonds, GICs, rental properties, and other investment assets. Over time, Many corporations built large investment portfolios while still benefiting from the same small business deduction that was originally intended to support business growth. So the government asked an important question. If a corporation is generating substantial investment income every year, is it still operating like a traditional small business? To address this concern, Canada introduced what we now call the passive income grind. The basic idea is actually quite simple. As long as a corporation or an associated corporate group earns $50,000 or less of passive investment income each year, there is no impact on the small business deduction. The corporation continues to enjoy full access to the preferential small business tax rate. However, once passive income rises above $50,000, the small business deduction begins to shrink. The more passive income a corporation earns, the less access it has to the lower small business tax rate on its active business income. And eventually, when passive income becomes large enough, the entire small business deduction can be eliminated. Notice something very important here. The government is not trying to punish businesses for being successful. The objective is not to discourage growth. Instead, the goal is to prevent corporations from accumulating large investment portfolios while continuing to benefit indefinitely from tax advantages that were originally designed to support active business operations. In other words, the government wants to maintain fairness between individuals and corporations. It wants to reduce excessive tax deferral opportunities. It wants to preserve tax integration. And it wants the small business deduction to remain focused on helping genuine businesses grow and expand. This brings us to the key takeaway of the entire discussion. The small business deduction was designed to help businesses grow, hire employees, purchase equipment, and expand operations. It was never intended to help corporations build unlimited investment portfolios using permanently lower tax rates. And that policy objective is the foundation for everything that follows when we begin calculating the actual passive income grind rules.